Singapore Deputy Prime Minister Heng Swee Keat says the government is not expecting a recession despite the country's slowest GDP growth in a decade. Now, he says there are areas of strength in the economy, such as the infocoms and construction sectors, even though GDP was up by just 0.1%, according to official flash estimates.
He posted this on Facebook following the release of the second quarter GDP estimates earlier today. Mr. Heng also said the government is monitoring the situation closely and is working with employers and unions to, quote, prepare for all scenarios.
He reminded Singaporeans to continue focusing on the medium and long term while tackling shorter-term challenges of the economic cycle. Mr. Heng said the Future Economy Council, which he chairs, will continue with its industry transformation plans while strengthening enterprise capabilities and making the most of opportunities.
Meanwhile, economists are downgrading their full-year GDP forecasts for Singapore. They cite a protracted US-China trade spat for their revision.
Flash estimates for Singapore's second quarter growth was 0.1% on year, and it's the slowest growth in a decade and weaker than what analysts expected. Eugenia Lim with more.
The fallout from the US-China trade spat was evident in Singapore's weaker manufacturing sector. The services sector is still sluggish, while construction activity is cooling down. The Ministry of Trade and Industry previously said Singapore's full-year GDP would be between 1.5 and 2.5%, but there are signs the forecast range could be revised in August. Looking at the current developments, economists are downgrading their forecasts.
It would be prudent to actually shade the range down to 0 to 1% range, because to get to 1.5% for the full year, that actually requires a fairly sharp uptick into the second half. It has to average about 2.4% year on year, which I think at this juncture doesn't look like it's realistic.
Singapore's Q2 GDP shrank 3.4% on a quarterly basis. It's a sharp drop from the 3.8% growth from the previous quarter. And economists are sounding the alarm of a possible technical recession. The latest GDP figure is the deepest quarter-on-quarter contraction since 2012, and economists say this indicates a rising risk of a technical recession, and that's defined by 2 consecutive quarters of slowdown.
Since the start of the year, growth has been much weaker than we've been expecting, and the continuous rounds of downgrades to everyone's expectations of growth, that tells you you really can't rule out the possibility of a recession.
The head of Singapore's central bank has said if the US-China trade war drags on, there could be weaker growth in the second half of the year, which could impact the labour market.
As far as wage expectations, hiring intentions, probably we'll see a little bit of a dampening in terms of expectations going forward. The key really is what happens to the services sector, because they provide the bulk of the employment.
Economists say the odds of Singapore Central Bank easing the monetary policy is increasing. The official second quarter GDP will be out in August.
They were expecting much better numbers than what we have. Given where we are now, the economy looks like it's in need of much more accommodative FX policy from the central bank. So we're expecting MAS to ease the FX policy settings in October through a reduction in the Singapore near slope.
Brian Tan, regional economist at Barclays Investment Bank.
Now, despite the disappointing data, the benchmark Straits Times Index ended the day up by 0.1%. Meanwhile, the Sing dollar weakened slightly against the greenback.
Singapore Trade and Industry Minister Chan Chun Sing says the government remains focused on attracting high-quality investments for the long term. In a Facebook post, Mr. Chan says the pipeline of investment shows Singapore is on the right track.
He cited Singapore's pro-business ecosystem, skilled workforce and stable political environment among the reasons why businesses are locating here. Mr. Chan added that significant investments by companies like ExxonMobil, GSK and Dyson are testament to Singapore's strong fundamentals.
However, he cautioned that the current challenge is the longer-term shifts in supply chains and production patterns. He says the government's strategy is to build new capabilities, expand into new markets and acquiring new skills.
Mr. Chan said Singapore is not alone in upgrading and the key is to act faster than the rest. Mr. Chan says the government is committed to help businesses and workers transform.
Turning to workers, Singapore Manpower Minister Josephine Teo says the government is ready to provide more employment support when needed. In a Facebook post, she said the weaker GDP estimates would be concerning only if people did not notice it.
Mrs. Teo said many in the labour force are paying close attention and are not panicking. Instead, some are preparing by being more flexible in their job search.
She added that nearly 60,000 jobs are still unfilled. Half of those are PMET jobs in sectors like financial services and infocom technology.
Mrs. Teo says as the economy transforms, new and better jobs will emerge. She also reassured Singaporeans that there's no shortage of training programs to support workers.
The minister says nearly 76,000 Singaporeans moved into new jobs through the Adapt and Grow initiative from 2016 to 2018. Currently, there are some 100 professional conversion programs in more than 30 sectors.